I don't think the Fed or even the Treasury, could the Treasury tokenize the gold that it supposedly has in Fort Knox? That's possible, but nor the bankers. So yes, they might give you some gold tokens, treasury gold tokens, but the only way I would trust it is if I would be able to redeem it very easily. If I could go to any bank that's regulated by the Fed, the Treasury, go to your own bank and give, show them your token and ask them for a gold coin, a gold bar, or whatever it is. If you could do that, then yeah, I kind of would trust it a little more.
The global commodities market is ripe for disruption through blockchain-based tokenization. Unlike traditional financial systems, which rely on intermediaries and slow settlement processes, tokenized commodities enable fractional ownership, faster transactions, and lower costs. Gold, with its massive daily trading volume of $233 billion, stands out as the most logical candidate. Its deep liquidity and historical role as a store of value make it far more stable and practical than Bitcoin, which trades at volumes roughly 4.5 times smaller. But here's where the discussion shifts from technology to trust. Mario Innecco from Monaco64 raises a critical question. Could governments tokenize gold? Technically, yes. But would that solve the core issue? Not unless you could redeem that token for physical gold in person without delays or bureaucratic hurdles. And that's unlikely. A token controlled by a central entity is still subject to the same trust issues that plague fiat currencies. It becomes another digital promise, backed by institutions people increasingly don't trust. Meanwhile, demand for real, tangible gold is accelerating. Gold Republic reports annual growth in transaction volumes of 25 to 40%, a clear sign that investors are hedging against currency devaluation and systemic risk. This isn't just about preference, it's about survival in a system where monetary policies are pushing more people toward hard assets. Innecco warns that once gold prices shoot significantly higher, and he believes that's inevitable, there will be efforts to lure people out of their holdings. That could come in the form of eye-popping fiat valuations or flashy token schemes. Either way, he argues, the goal will be the same: to part people from their physical gold. He makes his stance clear: hold your gold and silver in your own hands. Ignore digital imitations, no matter how convenient or lucrative they appear. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
What about gold and silver? The last couple of days of this past week haven't done really too well. They've come off a little bit. Well, yeah, in the short term, there will be noise. But if you look at these long-term charts, gold and silver still look very bullish, i.e. the dollar looks pretty sickly. And I think, yeah, can you imagine if the stock market wasn't doing as well, if the economy wasn't doing as well, how much more rate cuts really this system would need? And this has all got to do with what happens in nature. And by nature, I mean the markets, currencies, human action. And you can read about that in Fiat Money, Inflation in France, written by Andrew Dixon White. He says that when you start inflating the system or issuing currency out of thin air, yes, you improve the economy, but ultimately those issuances lose their power. Then you have to issue more currency. And every time you issue currency to keep the economy going, you have to do it more. It's almost like a drug addict starts out really taking small hits, right? And then becomes more and more pronounced. And at one point as well, the drug has no effect, and the drug addict, unless he or she does something about it, they will die. And it's the same thing for this financial system we have. And I think we're close to the point where it dies. So yeah, and with that, I'll come to tokenization. So the key word is token. What is a token? Well, it's just a representation of a real thing. So right off the bat, I don't like it. When I talk about gold and silver, that you should have some to protect your savings. I mean like silver coins like this, not a token. And yes, I know this is all to do with this new Genius Act, tokenization, cryptos, that it could be for good for gold and silver. But ultimately, I think the best thing is to have these handy, physical gold. And here in the UK, I know it's getting expensive gold. You can get one of these. It's a quarter of a sovereign, or half a sovereign, excuse me. I think that's worth about 280 pounds. So yeah, that used to be the price of an ounce, right? But yeah, tokenization, I don't know how it would work. It would probably be, of course, because the US is saying that they don't want to do central bank digital currency. So I don't think the Fed or even the Treasury, could the Treasury tokenize the gold that it supposedly has in Fort Knox? That's possible, but I don't trust government, nor the bankers. So yes, they might give you some gold tokens, treasury gold tokens, but the only way I would trust it is if I would be able to redeem it very easily. If I could go to any bank that's regulated by the Fed, the Treasury, go to your own bank and show them your token and ask them for a gold coin, a gold bar, or whatever it is. If you could do that, then yeah, I kind of would trust it a little more. But yes, a token is just a representation. So that's the way I see it. And I think they will want you to give up your gold. They might not make you give up, but with what's happening, the gold price in fiat dollars is going to go through the roof. And I spoke about that with Andrea Cecchi the other day. And I think it was a great interview. I'm going to put it up here in the cards. And he said that you should keep your gold and silver, hold on to them for dear life, because they're going to lure you into getting rid of it at really high prices. And do you really want to get rid of it for more fiat dollars or maybe a token that you know nothing about? No, I would hold on to it, and I don't trust tokenization one bit.
Trump, who earlier this week referred to Jerome Powell as a numbskull for ignoring the White House's push for sharp rate cuts, wrapped up his visit to the Fed's $2.5 billion construction site in Washington with a surprising statement. He doesn't intend to fire Powell. That's despite having floated the idea multiple times before. Mario Innecco points out what happened next. Trump publicly stated that he believes the Fed is about to start cutting rates many times and aggressively. That's a bold prediction, especially since the market isn't pricing in any near-term cuts. But the comment introduces uncertainty and possibly sets the stage for a policy surprise at the upcoming Fed meeting. The whole exchange was unusually tense. The optics of Trump pressing Powell at the Fed's massive headquarters project underscore just how much pressure the White House is applying to shape monetary policy. And the timing is critical, less than a week before the Fed's 19 policymakers meet to decide on rates, which are currently sitting in the 4.25 to 4.5% range. As for Innecco, he doesn't mince words. He doesn't support the Fed or any central bank. His argument is straightforward. If we had fundamental free markets, sound money, and minimal government interference, there'd be no need for central banks in the first place. In his view, the constant manipulation of interest rates and money supply creates distortion, not stability. This latest episode, with Trump trying to force the Fed's hand, just reinforces how far we've drifted from anything resembling a free market. Let's get back to the interview.
To the main topics, and President Trump and the chairman of the Federal Reserve, they met a couple of days ago. There's this question now of whether the Fed is abusing its spending power in terms of renovating its headquarters and other buildings that they've been renovating, like the Martin building, which I'd never heard of. Their headquarters is the Mariner Eccles building. But one thing I would say is that you would think the Federal Reserve would just print the money. They don't really need taxpayers' money to spend. So I think what's going on here is that President Trump is using a strategy I read about. It's called flooding the zone, which is basically attacking an institution from all sides to try to make them do what you want for them. And I think it was quite telling towards the end of their meeting. Someone asked President Trump a question. He said, well, I'm not unhappy with him. I just want him to cut rates. And he patted Powell on the back. Powell smiled. So I think that was a very subtle message to him. Yeah, you cut rates, we'll forget about all this investigation about the renovations. And I think later on yesterday, I think President Trump said, I think the Fed is ready to start cutting rates many times and aggressively. So yes, they have their meeting, 2-day meeting this week, Tuesday and Wednesday, and the markets don't expect them to cut, but I think there could be a surprise there. And as for the Fed, well, hopefully all of you know that I'm totally against central banks. And why is that? Well, because in a supposed free market, small government, sound money economy, you don't need a central bank. Central bank is a monopoly. You don't need a committee of 12 or how many ever people they have on the FOMC to decide what rates should be. The market should decide that. What I think this conflict between Trump and the Fed is doing is creating a crisis of confidence in the dollar. And why do I say that? Well, because we're seeing a melt up. And it's not because the economy is doing great. If the economy would be doing great, of course, Trump wouldn't want the Fed to cut rates. What's doing great right now are these financial indicators like the stock market, commodities, not maybe the bond market, but it's pretty steady for now. But someone asked Trump about the dollar, and he made a really interesting comment, and I've got it here. And this was his reply. I don't know who asked him the question, but Gold Telegraph posted it. And he said, I'm the person that likes a strong dollar, but a weak dollar makes you a hell of a lot more money. So what does that mean? It doesn't sound right, does it? Well, he's talking here about the Cantillon effect. It makes him and his fellow one percenters, fellow billionaires, a lot more money because a weaker dollar, yes, makes assets look much better. It makes, it makes the system more flush with liquidity, and the people at the top, they're nearer to the printing press or the central bank than, let's say, someone working a minimum wage job is. So that's why he's saying he likes a weak dollar. It makes him a hell of a lot more money. And I commented, I said, it makes more money for those who are closest to the printing press, the Cantillon effect. But for the masses, it's a massive tax, currency debasement, AKA inflation. Yeah, and inflation is not the CPI, and I'm gonna keep going on about that. So that's what he meant there by he likes the talk of a strong dollar, but deep down he likes a weak dollar. So that's what's happening. And this is a melt up, people. It's not good. And this is why the stock market is making all-time highs. But I suspect that Mr. Powell holds the key to whether we're going to see a major crash or a major melt up. But either way, if we see a major crash, he'll have to come in and cut. So yeah, there's a lot of frustration, a lot of people calling for a crash in the stock market. Professor Steve Hanke, he posted a chart here from North Star. He says, according to my bubble detector, the U.S. stock market is once again in bubble territory. And North Star says we are in official bubble territory. The countdown has started. You've been warned. So he looks at the NASDAQ versus M2 money supply, and the NASDAQ is breaking out. It's the highest it's ever been. But could it be that the crash and the deflationary collapse is going to be against this kind of money, this kind of measure of value, not the fiat dollar? And by this, I mean gold, of course. Well, I think there's a big possibility, and many people are not really factoring that in, and I am. And that's why, yeah, I'm not too sure if we're going to see a major crash or correction in the stock market in terms of the fiat dollar, right? But in terms of gold, I think that's different. So how would that work? Well, it would work that the currency, the dollar, the paper dollar would keep dropping very quickly versus real money, i.e. gold, and it would drop quicker than the stock market would go up versus it. So the Dow gold ratio actually go down, keep going down. The S&P to Dow ratio would keep going down as well. So that's the way I see it. Either way, I think things are set for a huge, how can I say, event coming this week. If the Fed cuts this week, yeah, look out above in terms of dollars for the stock market, and look out below for the dollar in terms of real money.
Digital tokens backed by gold sound modern, efficient, even inevitable. However, without guaranteed instant redemption in physical form, they risk becoming just another IOU in a system that includes them. As power struggles unfold between political figures and central banks, the notion of trusting institutions to manage anything long-term, especially something as fundamental as money, feels increasingly misplaced. What's unfolding isn't just a debate over policy or platforms. It's a more profound reckoning with who controls value, and whether that control is even legitimate anymore. When the next phase of this monetary shift hits, will you be holding something real or just a digital version of a promise? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.